here early. Appreciate you coming by a few minutes ahead of time. Whether you're new to trading or just new to our group, I want to welcome you to the opening playbook. The opening playbook is a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding. We offer market insights, that's timely analysis of what's moving the markets right now, trading education to help build real skills beyond surface level tips and tricks, and live trade ideas, which are real-time recommendations that you can act on immediately. Opening Playbook is a free daily live webinar. And the stars of our show are Nathan and Graham. Nathan has over a decade of experience trading Forex stocks and beyond. He's worked with dozens of leading global experts on strategy development. He's obsessed with math and systematic edges in trading. He's the creator of the Income Machine, Overnight Options, and more. He's a husband, a dad of 7, and the publisher here at the pub. Graham Lindman is also an options expert with over a decade of market experience. He studied technical analysis under 2 of the top minds in finance. He developed his infamous wrap order option trades for cost-effective entries and has created lightning trades, moonshot alerts, NVIDIA Elite, Apex Indicator, and Newton. A lot of people in the stock market education industry will tell you that trading is easy if you just know their quote-unquote secrets. Well, that's not us. We'll tell you the hard truth, which is that trading is complex and takes time to learn. However, we can make the learning process much easier. The opening playbook exists because a lot of traders have trouble succeeding because they believe many of the myths out there about the market and trading. We'll dispel those myths and equip you to become a better, more mature trader, giving you the opportunity to be more successful, whether that means using our systems, tools, and strategies, or just trading on your own. Remember, our goal is to be a bridge for both new and advanced traders to go beyond outdated market narratives into deeper understanding of the markets. It's important to always remember that you should never trade with money that you can't afford to lose. Nobody likes losing, but there's a difference between losing some of your investment portfolio and losing the rent or grocery money. So please remember to keep your risks in check and never trade with money that you can't afford to lose. And let's be ultra clear, any type of trading will involve some losses. It's inevitable. Controlling your risk will keep you in the game, and we can help you learn structures and strategies to do just that. Our promise to you is that we'll be honest and transparent with you about what works and what doesn't, what you should make your own decisions about, and what rules we think you should always follow. A few simple rules to start you off with are stay calm, as in trying to trade without emotion involved. Very difficult. Go at your own pace. It's not a race. You don't need to keep up with us or other traders. Go at your own pace and ask questions freely. We really do want to answer your questions and help you as much as we can. To help you get started, we'd like to offer you some free information. Answer a few quick questions by clicking the link in the banner that I'm about to pop up at the top of the screen. There you go. And for doing that, we'll be able to give you a couple of things. We'll be able to customize the content in Opening Playbook based on your feedback to provide better content suited for you. And we'll give you a free options cheat sheet, which is a digital, easy to understand options guide that looks something like this, but will be a lot less blurry when you get the actual thing. Now, I just want to take a couple of minutes for those that are new to Opening Playbook to talk about this platform that we're using. Obviously, it's a little different from a typical Zoom platform, and I want to help you get the most out of these webinars by showing you how to use this platform a little bit. You can click on the hamburger icon. That's what we call those 3 horizontal lines in the top left corner of the screen to reduce the size of that green column on the left. We don't need the green column, so the smaller it is, the more room we have for other things. In the bottom left corner of the display area, you'll see a little speaker icon. That is the mute and unmute button. If you do need to mute us for something, you can click that, Or if you find that you've suddenly lost audio, but the video is still going, you may have accidentally clicked or tapped on that speaker icon. So check that if you lose sound. In the bottom right corner, you'll see two different icons, or you may not see both or either of them. It depends on which platform you're running this software on. So if you see that double arrow there, that can be used to go full screen with the presentation area. It will hide everything else and show you maximum size on the display. The square inside of a square is the picture in a picture. That will actually pop the video out into a small floating window so that you can do other things in the background, like go to your broker platform or another website. Now, as I said, you may see one, both, or neither of these icons depending upon what device you're on and which web browser you're using. You should all have this icon below the video presentation. It's a little monitor icon, and this will be good, I think, for most people to use. This will give you maximum size on the presentation area without hiding the chat. So you can still stay in communication with the chat, but see the presentation as big as possible. And next to that is this low latency slider. If you're having any performance issues where it's like buffering or kind of locking up a little bit with the audio or the video cutting out, click on that low latency slider. That will cause a few seconds delay in you getting the feed, but should smooth it out for you. And a few seconds probably won't make a difference. The whole column on the right is dedicated to communication with the chat. The big area in the middle vertically is where you'll see your chats as well as everybody else's. Keep in mind that this is a group chat. Whatever you type in this box at the bottom, it will go in that column and everybody will see it. So you would just type your message at the bottom and either hit enter on your keyboard or tap on that little green arrow to submit your message, and it will post in the group chat. However, there's a toolbar at the top which gives you some other options. The first one, which is the right arrow, although it's all the way on the left, will collapse the chat area. I don't recommend that because there's a lot of important things that happen in the chat. You probably want to keep the chat open. The megaphone or bullhorn icon will bring you to the announcements tab. The announcements will have any live trades that we've taken during the session, as well as a static set of helpful links. If you've never seen the helpful links, I highly recommend you check that out. And this double speech bubble icon is for private messaging. This is where you can send messages that the whole group will not see. When you click on that, you'll be able to private message any of the hosts. And if we send you a private message, you'll see a little red dot up in this green toolbar to let you know to flip over to this tab. So look for that little red dot up there occasionally to see if you have a private message waiting for you. And then if you want to get back to the group chat from either of these other tabs, you just click on the speech bubble with the three dots in it. Last but not least, we have this diagonal arrow icon. This will pop the chat out into its own floating window. So if you're using multiple monitors, let's say, and you want to go full screen on the presentation in one monitor, you can pop the chat out and have it on a different monitor. And that's it. So once again, welcome to Opening Playbook. Please don't forget to complete that survey. And even if you're not brand new, the survey is relatively new. So if you've never filled out the survey, please, you don't need to be brand new to Opening Playbook to do it. We're happy to give you that cheat sheet as well. Even if you've been here for a year, if you haven't filled out the new visitor form, click on that link in the banner above to complete that survey, and we'd be happy to give you that options cheat sheet as well. So now we're going to play the theme song, and then we're going to get into our regular show right at the top of the hour.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Such energy sharp like a razor blade. This is where the big plays are made. Oh. Charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options and plays in a live display. This is where the big plays are made. Oh. Charts are lighting up the morning sky. They spot the trends with a hawk's eye. Options and plays in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh. Step by step they break it down. No confusion, no spinning around. With every trade they set the tone. Making big calls from their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Well, good morning, everyone. Welcome to the opening playbook for Wednesday, March 18th. Happy home day. Hope everyone's having a good Wednesday morning. We have Mr. Nathan Tucci with us right now, and I believe we have a special guest coming on this morning as well, so stay tuned for that.
We do indeed. Get crazy that it's already Wednesday, halfway through the week already. Well, I shouldn't say halfway, but
Getting there.
getting there. At about 1 p.m. we'll be halfway through the market for the week. Had a really nice positive drift overnight. Market finished kind of in between yesterday. We talked about it had a nice surge up, ended up finishing pretty close to the open. International market actually got that rolling, and we were up about another 0.5%, maybe even a little bit more at the peak. I'm not sure what the peak was, but we were up pretty nicely there. And then early this morning, sold off most of that. Looked like we were going to open right about break even. Then we got the inflation report at 8:30. That shot us down about 0.5%. So we actually went down almost a full 1% in those couple hours from the overnight peak to where we opened. Pop back a little bit right now, and are kind of in between. Everything kind of where we'd expect. Nothing crazy here. RSP, Mags, Qs, SPY, all pretty much in the same place. The big story right now, I think, is that gold is taking a bit of a hit. It's down about 2.4%. Now, keep in mind, gold being down 2.4% in March of 2026 is not the same as gold being down 2.4% 2 years ago. Gold has moved a lot more. It's a lot more volatile right now. The average range has significantly opened up for gold. So that 2.5% move, while significant, is in relative terms not a major move for gold in the stage of volatility that we're in right now. So we'll keep an eye on gold. Might talk about that a little bit later as well, but definitely the kind of the outsized move right now, and then Bitcoin down about 3%. Sector-wise, technology is actually holding up right now. This goes back to what we've been beating the drum about for a little while now, that there is some strength in technology underneath the surface. Hopefully, if the market can get some more participation from the rest of the sectors and just some liquidity and some positivity back in, I think the fact that technology is getting stronger is a good sign that we could have a move up. Right now, I think we are pretty headline driven with the conflict and some inflation here today coming in. Once people come out and start talking about rates going up, I'm concerned that'll be a nice catalyst for a move down because it's it can't be too long before the odds keep creeping up there for a rate hike instead of a rate cut. And I think in the short term, the market is not going to love that. So we'll have to keep an eye on that. But for right now, we're getting a pretty neutral net overall. Nothing really down a ton. I mean, healthcare, but 1.5% also for healthcare is not really a huge move. It's become more volatile. Interestingly, on a down day, staples are getting hit today, which we don't typically see. Typically, would see if the market opens 0.5% down, staples would be in one of the better positions, but not so today. And then energy still creeping up. Obviously, energy's been on an incredible run here since the Iranian conflict, and actually even a little bit before that. And it's continuing to grind up higher. Your Chevrons, your Exxons, et cetera, continuing to move upward. And then on our heat map, we're a little worse than 50-50. This is about 10 minutes old, I think, from the last update. So a little worse than 50-50 on our top 100 in terms of the overall heat map. You do see some technology up here at the top between AMD and ANET and Broadcom and several others. So again, some of those bigger tech names are holding out. NVIDIA is a little bit green as well. It's NVIDIA is just holding the line in that range, though we've been in for a while. And so it's been another pretty net neutral move. And then as we scroll down, you'll see some of the red names here. Some of these are staples. Some of these are communications like Verizon and AT&T. So a decent mix to the downside like we saw in the sector side of things as well. I really think for the most part, we just have to decide what we're going to do at this decision point in the overall market. We're still fairly close to that 670 level on the SPY, 668.30 right now. Got to figure out, got to figure out what we're going to do from a decision point here. I think the weekly chart is a good indication there. So far, it's made a really nice turn to the downside. Looks like it wants to move down, and we'll kind of see on Friday how that ends up looking for the overall market. Last thing to mention, I did get out of Docu. I failed at 59. Is that what I failed at? 59. So nice 78% gain or so there on our earnings trade. If you guys are still in that, I got out at 59 cents. I think similar pricing right now, and another good earnings trade.
Nice job.
Yeah.
Awesome.
Hey, everybody.
Hey, Jeffrey T.
How's it going?
Oh, going good. What a fun last night. We were up pretty big in the post-market hours just to wake up down today. As a reminder, guys, I told you we're going to check this. It's been a very boring chart for us for some time, the investment grade credit spreads. We just want to keep an eye. If this number starts to tick up above 1, it becomes kind of our yellow warning sign zone. We talked about this yesterday. If you compare, so you can see anytime the investment grade credit spreads are below 1, the chart's marked green. Anytime it's between 1 and 125, between that zone, that's kind of our yellow zone. So see yellow here, that's where the chart's marked yellow. So it's a good little visual. And then above 125 is those red times, which as you can see, typically lean towards a much larger drop in the markets. They didn't update their chart yesterday, but I just got into it today. We are still seeing this escalation, if you will. We are not to 1. I wish I could squeeze this. I can't. We are right here, 0.94, 0.92, I believe. Oh, 0.94. They just updated it. So 0.94. We were very, very close to that 1 number, which again doesn't necessarily mean a crash is coming. It just means we may need to be a little bit more cautious if we get there above that 1. So as I told you guys yesterday, just to recap, if you missed, I normally like to give you guys a prediction every Tuesday and say this is where I believe the market's going. I did not do that yesterday. I'm just waiting for the price action. I'm waiting for Very, very simple indicators, guys. Nothing fancy here. But if we get a close above 100-day, I'm looking to buy the breakout. If we close below 200-day, I'm looking for us to move down to 6,200 on the S&P 500. Today, again, last night, I was like, well, we might be heading towards that 100-day moving average much faster than I thought. And then not so fast back into the choppy zone. So that's why we've got Jeffrey Turnmeyer on here today, who's been spot on the money with a lot of his prediction over the last couple of years. Jeffrey, we're curious on what you're seeing right now and ways to take advantage of this current market.
Well, I really got asked to bring some statistics behind high probability trading, but right now we're in a correction. I mean, it's been a correction. I think I've seen you post about it in the company chat. Nothing's really happened since back in October. We've just been kind of bouncing along. We did make a higher high in SPX, but NASDAQ hasn't made a higher high since October. Hard to believe when you think about it. The big tech, big driver for our whole economy for decades is stuck for like 6 months.
Yeah,
it's hard to make money.
it's very hard. I mean, Nvidia has been flatlined since what? Since July. July, Nvidia's been completely flat.
Nvidia's been flat since July, while the company revenue has gone up 65% in that time.
Yeah, true.
But it shows you, the cart kind of got above the horse on the stock price, I think.
Yeah.
And now the company, performance is actually trying to catch up to that crazy high valuation. And we may see it retest the breakout that we had back in December 2024 before it could actually go higher. So I'd be careful playing big tech and playing anything right now. And NASDAQ needs one more lower low. We had that immediate fast pullback into Thanksgiving, and then we've been just churning at levels above that. I think we need one more flush, just get the weak hands out, get the dip buyers, recalibrated, and then we could maybe push higher toward the second half of the year. I would hate for it to take that long, but it's looking like we may, the longer we prolong this flush out,
that's what we had. We had Chris on the other week, and we're just both like, man, can we just dump already? Can we just get this over with?
Just rip the Band-Aid, let's get it over with, and we can reset everything, go higher. Even Bitcoin's not been performing that much. I did a roundtable with you guys a couple of weeks ago, and everything I outlined is kind of still holding. It's just, where's the money going right now? It went into oil, and we saw it go into gold. Now it's pulling back out of gold and silver, went into oil. Where's the next place that we're going to see secular rotation though? And oil has concentration risk, if you will.
Oh yeah.
It's, I don't know if, there's lots of projections. If this thing goes crazy, we could see, I see a lot of predictions for 150 oil, but the price action suggests maybe we breach 200.
Wow.
And the real crazy thing has happened if you take dollars out of the equation. If you just take gold and divide it by oil, which eliminates the price of anything in dollars. It's just gold priced in oil, barrels of oil. Historically, 20 barrels of oil get you an ounce of gold. We got up to 50 barrels of oil per ounce of gold. And we're probably going to pull that back to 20. What that means is in dollar terms, oil's probably going higher, gold's probably going lower. You could pairs trade it if you wanted to. Short gold, long oil, they're going to come back into parity. They could both go higher and oil go higher at a faster rate, and that could put us at 200 oil. Inflation wise, oil's just not priced right. It's kind of been stuck at 40, 50, $60 a barrel, and it's kind of a bummer for everybody that has to fill up with gasolina. But my truck runs on sunshine, so that's okay.
And there's plenty of that coming. We got something coming.
So anyway, I got asked to bring statistics behind high probability trading. Hopefully that's okay with you guys.
That's what we do here.
Yeah. Nate was talking a little on the side with me and, said, make these cool slideshows. So I made one of these cool slideshows to bring to opening playbook and show off. And, you guys can hang out or you can take off. I don't know which way you want to do it. But I brought this. And now for those that don't know me, I got started in 3rd grade and I've built up my knowledge in the markets. It's been a long, grueling, tough go. I got a degree in civil engineering. I have taken master's classes, graduate classes in AI programming and computer science. I've done, really jumped into Elliott wave theory, back testing, looking for proprietary patterns that I can exploit in the market. I just like to collect knowledge and skills as a hobby. And my wife says I collect hobbies as a hobby. So now a 90% win rate on a system, that should make you pause. If anybody claims a 90% win rate, what you hear when you get sold a 90% win rate is, I'm never going to lose again. And 90% win rate's like a guaranteed system. And, this algorithm is perfectly optimized. But what the math actually says is that losses are probably going to be 10 times bigger than the winners. And that might make this system a net loser. I mean, think about it. 70 to 80% of retail traders, day traders especially, lose money. And today I'm going to talk about how we kind of fix that a little bit. So I have about 45 minutes lined up here of just pure statistical education. Maybe it's going to bore you. I'm a very nerdy person for those that have met me in person or haven't met me in person. Let's talk about what an actual high probability trade means, the market roadmap pattern and how it's a 74% win rate pattern. I'm going to talk about some Fibonacci, real mathematical levels, how I've back tested over 100,000 charts with this pattern, why 30 trades is a minimum if you're going to bring any kind of statistical meaning out of a system, some empirical rules and what that means for trade timing, win rate versus expectancy versus profit factor, kind of give you a full picture of what all these numbers that get thrown at you mean, and how bring it home with some risk reward position sizing, some math to keep you in the game long term. Now, before we begin, substantial risk of loss in all trading. This is informational, educational, probably fun, maybe a little entertaining if you like nerdy stuff. You can lose money, though, doing this thing we do called trading. Now, high probability, like a 75% win rates, not 90, not 95. This is what high probability is in the market. This is my market roadmap pattern does about a 74% win rate across tens of thousands of trades. 74 out of every 100 trades work out in our favor over a large sample size. The bad in that, though, 26 out of those 100 trades fail. But that's expected and mathematically planned for. And it's not a flaw. It's not a broken system. It's just part of the reality of the honest, statistically validated system here. Now, claims of 90% win rates, they're either not fully tested or they've been cherry-picked or they're hiding or, maybe have that outsized potential catastrophic loss hanging out there in the future. So be careful on that. Always want to know what the max loss is. Win rate can be one of the most misleading metrics in the entire market. If you have strategy A with a 90% win rate, average win $100, but your average loss could be $900. When you do 100 trades, that actually ends up being a net loser. Strategy B, you can make a $500 average win, average loss $200. It seems like, oh man, I'm 2 steps forward, 1 step back, but on the whole, it's actually a profitable trade. And then you could actually go with a 40% win rate if your wins are big, much bigger, 5 times bigger than your losses. This can actually end up being a profitable trade. Right there, you get $100,000 wins when you win, but you lose, $200 each time you lose. But over the long term, a 40% win rate can actually outperform a 90% win rate strategy. It's just all in the math. A lot of people don't stop and do it. Maybe you don't know how. Now, the math behind the levels that I like has been in nature for centuries. I call it, I like to look at it as Fibonacci. I look at them as, kind of market math is what I call them. Leonardo Fibonacci introduced this sequence to Western mathematics in 1202. So the year 1200. And Ralph Nelson Elliott applied it to financial markets almost 700 later in the 1930s. So the way I use this, numbers that matter, what it is a form sequence. You take 0 and 1, you start adding them together to get the next number in the sequence. So it goes 0, 1, 1, 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5. And that, this 144 is a key level for me right here. Now, some ratios 1 divided by the 1618 is a reciprocal of 5. 38.2 is 1 minus 618. 618 is kind of the ratio between the numbers right there. The golden ratio, if you've ever heard of this, maybe you've heard this, it's 1.16, 1.618, 039, blah, blah, blah. That's the golden ratio. We find this in nature. It's actually the proportions of your arm. The pieces of your finger, the way they get longer, it's 1.618 times. Your hand to your wrist to your elbow. It's crazy how this works. And we find this all over the place. It just looks good to us when we see these ratios. Sunflower spirals, seashell spirals, the way they grow, all on the golden ratio. Now, 144, when you square root that, you get 12. And to get my roadmap line, I like to grab 12 squared, 144, 13 squared, the next number, in the sequence, and get 169, and that makes up my market roadmap line. But there's some levels in here that I like to use for support and for targets. Now, this 618 level, that's a primary entry zone right here. I'm going to show you more about this pattern and the math in it. But here's some of the places where these numbers come from. I use a primary target of 1272, and because there's different ways you can calculate these mathematically based on the market and stuff like that, people think they're kind of bunk because you throw some fibs on the chart, you don't understand all the different ways you can calculate it. Sometimes you can use log mode, sometimes you don't, and they actually result in fuzzy zones between the 2, 3, 4 different ways you can calculate these. And so for my primary target, I actually use 90% of the 1272, which comes out to my own custom fib 1.1448. You'll see that more here in just a second. Now, I know this is pretty heavy stuff here, but 1272 is the square root of the golden ratio. And it acts as a natural extension to target when you get bounces in the market. Now, the yellow brick road, this is where I kind of combine it all together. I use the 144 EMA as the primary EMA in my market roadmap system. It's, 12 times 12, 144, and that is a Fibonacci number. I also mentioned I take the next number up, 13 squared, 169. I use those two EMAs to create a cloud, yellow cloud on, if you've seen charts I do, it's kind of a yellow brick road. It's the market roadmap, I call it. Now, this Fibonacci EMA cloud, when we're trading above it, it's a bullish trend. When we're trading below it, it's a bearish trend. And it's simple as that. And it's kind of a gravitational center. We see price come back and test it from both sides constantly. And those tests are tradable. Now, here's how the roadmap bounce kind of works. When we're in an uptrend or a downtrend, either way, we see price moving away from the cloud. It's a trend. And then we get to an extreme point and we kind of, maybe we have an exponential hook, maybe we don't, but we get to an extreme point and then we come back and touch the roadmap line. This creates the pullback. We had a trend, we had a pullback, and then the trigger is the continuation. When we get a price close above the 61.8% of that pullback, that's my entry trigger. Now, to get this, you draw a Fibonacci line, a 2-point, use your 2-point Fibonacci tool. You draw from the high point to the low point of that pullback, touching the roadmap line. And that 618 level, when we get a candle close above that, no matter the time frame, that's the entry. So entry, to re-summarize here, entry, a close above that 618 fib confirms that we're going back into the trend. The targets, 1.272 has a 70% probability. If you go with 90%, you up that win rate to 74%. Right there. 1618 is a natural first extension, but I like to go for that little bit tighter range right there and up the win rate even higher. Now, funny enough, the market knows that 1.618 is the natural extension. The win rate going for the 1272 is 70%. But if you go for that 1618, it drops to 35%. So the market's smart. It's not going to just give you free money. So there's a reason why you should be conservative on your exit targets. Maybe book some profit and leave a little bit to go for the bigger numbers. Now, stop loss is always $1 below the 0 extreme level. So if we're looking at a bullish pattern, when you have the move up on the chart, when you get the move up and the pullback, $1 below this low right here is always the stop. Now you'd be like, well, low price stuff at $10, that's like 10% extra on the stop. Exactly right. That makes it a bigger risk to trade lower price stuff. But this works, all tickers, all time frames. So you should know your risk before you enter. $1 stop beyond the extreme is the target. I mean, is the target for the stop. The target for profit, always that 1448 up there. That's the way I do it. This works on minute charts all the way up to monthly charts. So this can be a self-fulfilling prophecy or a mathematical reality. The answer is kind of both. You know, the golden ratio appears throughout nature, and us humans have used it consciously or subconsciously to program algorithms worldwide that trade on these same exact levels. When enough participants in the market are using these levels, the belief that it matters becomes a reality of the markets, and it works more often than not. And my man Elliott discovered this in the 1930s, and he figured out in the markets that we behave this way even before people had computers to do these 618s and stuff like that. People just, they like the way these proportions look on charts, and they act at these levels. And we have for centuries, and then we programmed algorithms to do it. And it's just kind of a self-fulfilling prophecy of the markets. You know, we typically see, for those of you that don't know Elliott wave, it's a 5-wave system. Wave 1 is the first move. And impulse waves, trending waves, typically happen in 5 moves. So we get wave 1, and then we get a retrace, which is a wave 2 retrace. Typically, we see that retrace to like a 618. Could be the 50, could be the 786, but 618 is the kind of the key level. Then wave 3, we typically see that extend. If it's a good solid wave 3, we'll see it extend and hit that 1618 target. Wave 4 typically retraces 38.2 of the wave 3. And then wave 5 often is the same size as wave 1. And these are things you can trade in the market. And that's how I get a lot of these big, bold predictions right that Nate and Graham joke about, that me being a master of predicting markets. So there's 3 unbreakable rules of Elliott wave. And really, you know, all the things that people say about Elliott wave, it comes down to 3 unbreakable rules and then a lot of guidelines. So first off, the wave 2 retracement limit. Wave 2 can never retrace below the start of wave 1. It's immediately, you know, whatever count you have, it's immediately invalidated if you go below the start of wave 1. It's not a, you're not looking at a 5-wave thing. Wave 3 can never be the shortest wave. Now, it doesn't have to be the longest wave, but it can't be the shortest. So 1, 3, and 5 are all impulsive trending waves. And commonly wave 3 is the biggest, and the strongest, but it doesn't have to be. It just can't be the shortest. And then wave 4 cannot overlap the top of wave 1. So if you got, what does that mean? You got to move up, wave 1, you got to pull back, wave 2, you got this move up, wave 3, and then you got to pull back, wave 4. Wave 4 can't come down and overlap the top of 1. If it does, this is not an impulsive move. It's not a trending move. It's not a 5-wave Elliott wave move. Some other thing. Usually I call that a corrective, choppy, hot mess. So if you break any of these rules, your count's wrong, you got to start over. Now, the human story behind this, why? Why does this work? Smart money enters the broader market, still convinced that the trend is down, news is mostly negative. Some of you may have heard me say in other places that we typically bottom a chart 6 months before the news turns positive on a daily chart. Then we get we get this wave 2 shakeout. Like we've got this initial move up off the bottom. People are starting to get convinced. But then we get usually it's a very swift, fast pullback in a wave 2. Prices failing to make new highs, but it doesn't make new lows either. And it kind of scares people. People think it's a dead cat bounce, but then it doesn't make a lower low. And then we start up again, and the reason wave 3 is kind of like this powerhouse is when we break out above wave 1, people start jumping on, sucks in the crowd. We get powerful momentum. But even that ends and we get a wave 4 consolidation, another pullback in there. And then, this one tends to take 2 to 3 times longer than this one. Wave 4s tend to take 2 to 3 times longer than wave 2s. So this consolidation takes longer. We've got people that are profit taking. We got, lots of dip buyers, and we get this chop. And then we finally get that final breakout, wave 5. We get a euphoric final little push higher. Usually matches the same size as the initial move. And then it runs out, and we get a bigger retrace. And this 5 turns into the next 1. And this will be the 2 of the next bigger move. So the core truth, markets are driven by human emotion, oscillating between fear and greed. Fibonacci numbers are just a way to measure these bounces. So I don't guess about this. I test it. I analyzed over 100,000 charts, all time frames, all, just about any ticker I could get my hands on, from a 1-minute chart, 5-minute chart, 15-minute chart, 30-minute chart, 1-hour chart, 4-hour chart, daily chart, weekly chart, monthly chart, all time frames. Rigorously tested this, collected the statistics, 20 years of historical data, 0% discretion. Now, what did I test it for? I tested for win rate, profit factor, drawdown, risk reward, and expectancy. The profit factor is the number that kind of proves profitability. Profit factor is gross profits divided by gross losses, right there. A losing system, if you ever see a profit factor under 1, that's a net loser. This one right here, now my system does come in this range. It's marginal. That's why you got to be very disciplined. Respect the stops, respect the targets, because I come in this range. This, a really good system. Makes it hard to lose money. This is an excellent system, and you could really scale if you ever find one of these. Right here. Win rates tell you how often you win. Profit factor tells you if you're actually going to make money over the long term. System with a 40% win rate can have a profit factor of 2.5, and the winners just blow away those losers right there. Now, what my backtesting actually found is that there's some poor entry points. A 382, like people want to front run. They want to get in early. I don't want to miss all the move off the lows. You can get whipsawed up right here. We see a lot of touches in the zone, and then it reverses and goes lower. 50%, another psychological trap. You suck in a lot of buyers, and then we turn it around and rip it lower. Even touching right up to the 618, we see people on this retrace, and then it sucks them down and stops them out. But when we get a close above the 618, this is the sweet spot for an entry. By the time we get up to 786, we've lost some of that advantage for making profit as we go up to the 1.1448 target. Trading is about maximizing the expectancy. The 618 retrace consistently generates a profit factor in that 1.2 to 1.5 area, depending on the ticker. Now, let's talk about standard deviations in a second. So one standard deviation, this is a bell curve. We're talking about a bell curve here. If you've ever seen it like this. So one standard deviation gets you kind of the middle. That's 68% of all the expectancy. We've got the average right down the middle, one standard deviation on either side. That gets you 68% of all the outcomes. If we actually add a second standard deviation out here, now we cover 95% of all the outcomes. And usually I like to hang out in this kind of zone, unless I'm going for something that has a particularly, like a lower payout, and I want to have a higher win rate. And then I go for a 3 standard deviation that covers 99.7% of all the price action and leaves just between these two sides, it leaves 0.3% of the outcomes right there. Those are extreme outliers. They're rare for a trade to take that long if you're looking at a timeline, or rare for price to go that far if you're looking at the average move and the standard deviations of that. So time is a variable. It can take trades longer to play out than this, but most of the trades play out in this time zone right here. So if you're actually looking, people get frustrated that they run out of time. But if you play in here, funny enough, on my system, on market roadmap system, 45 candles is the average. One standard deviation is 35 candles, though. So you add that, 35, 2 standard deviations plus 35, and 3 standard deviations plus 35. So most trades should wind up before 150 candles, no matter the time frame, no matter, if you're on a 1 minute time frame, that's like less than 3 hours. If you're on a daily chart, that's like 7 months right there. Remember, the candle maker is not open on the weekends. So if you want to account for all the time frame, but most trades should work out within this right here. If it takes this long, you're getting into like these rare instances, extreme outliers. Now, that long tail, the 1% that takes forever, it seems like. In a normal distribution, 99.7% of the trades resolve within 3 standard deviations, and that's the average time. The remaining, 0.3% is that long tail. Trades can drag on forever. Tie up capital without resolving to the gain or to the loss. And the longer a trade sits in this tail, the lower its chances of actual success. So the options trap for retail traders, it's kind of an annoyance to run out of time, but I mean, it's part of the game. Options decay eats up premium as you wait. So if you buy that extra time, that theta decay can eat up some of your premium. You can be 100% correct on the direction, but run out of time. And it sucks. So if you implement, if you know the average duration of a trade and then the standard deviations for that, you can kind of pick your options to take advantage of that 2 standard deviation block and then cut it as you're getting into the 3 standard deviation block. If a trade takes 3 times the average to win, you should just cut it. So back testing, pitfalls. A lot of people like to curve fit. They like to adjust and try to get the back test to match this, but then they don't ever consider forward testing. You get survivorship bias, testing only on stocks that exist today, ignoring those companies that went bankrupt or got delisted. And that artificially inflates the win rates because the worst case scenarios are not even in the test. They're not even in the data set. That's why I bought a historical data set of 24 years of data for even companies that went bankrupt. Another problem here is ignoring slippage and fees. If you don't take that into account, if you have a system that just barely makes money and you ignore slippage and fees, that can actually take a profitable system and put it into a not profitable system. And using an insufficient sample size, drawing conclusions from too few trades. We'll talk about this. 30 trades is ideal. Hundreds is even better for data to be statistically significant. Basically bad data leads to false confidence in a trade. False confidence leads to blown out accounts. If you believe in a system and it hasn't actually been tested. Now, a sample size of 30 kind of changes that. Anything less than 30 is just noise. A sample size of 5, 10, or even 20 trades can be heavily skewed by luck, random variance, and short-term market conditions. It doesn't prove any kind of edge. Now, there's a statistical threshold that crosses at 30 trades. The data starts to become a normal distribution, and the mathematical points, and this is a mathematical point where the true edge of a system starts to reveal itself. But that starts at 30. That's kind of the minimum. The reality check is that strategies that haven't been tested for at least 30 occurrences, they're kind of a hypothesis, not really a system out there. So why is 30 the magic number? Right there. It comes to central limit theorem, and it states that sample means approaching a normal distribution as sample size grows, and that reality kind of happens at 30 right there. It's just talk to a professor of statistics right there, and they'll explain it to you in ways that maybe you should just go ask an AI to explain it to you like you're 5 if you really want to know why the central limit theorem works right there. but that average becomes stable and predictable as we go above 30. Coin flipping analogy, just kind of, you can get 10 flips, right? You can flip a coin 10 times. You could get 7 heads, 3 tails. That's a 70% win rate if you were looking for heads. You're a genius, right? Flipping coins. I can get 70% of the time I can get heads. That's false confidence, right? We all kind of know it's a 50-50. As we get to 100 flips, maybe we're closer to, we're getting closer to 54%. Got 54 heads, 46 tails. My system's breaking down. I thought it was a 70% win rate, but now I'm dropping to a 54% win rate. Then as we get to like 1,000 flips, now you're getting closer and closer to that 50%. Even though we still have heads hitting more often than tails, it's getting closer, and it's honing in on that 50-50 that we all know flipping a coin does. So that's why a small sample size can skew your results right there, because you don't have enough data to look at this in a realistic way. Now, 6 trades means nothing, right? 6 wins, 0 losses, 100% win rates. Profit factor is infinity. Crack the code. The system never loses. I'm going all in on the next trade. That sets you up for a catastrophic loss. When you take that system and then you keep going for 30 trades, maybe the win rate drops all the way to 46% and the profit factor drops to 0.85 and it's a net loser. Right? You got to have 30 trades at a minimum. 6 trades could just be random luck. Could just be a market anomaly. The conditions were just right for this trade on that ticker. But if you have 30, it starts to give you the real picture. Now, law of big numbers, this can be your edge's best friend here. Now, if you're short-term variance in the markets, you can get tricked. All right, even on a larger sample size of trades, short-term variance in the markets, we have market cycles that go on, days, weeks, months, even years, even decades. There's market cycles that play out. So if you don't test for decades on a system, even on a small, like 1 minute time frame, you can get caught in a short-term variance where the market conditions were just right for the trade, and then when when the market changes, it screws you. So the long-term mathematical edge comes from doing this tens of thousands of times, not from just a few times. You want to be the casino. You want to have the house edge. You want to know that you're going to win more often than you lose over tens of thousands, if not hundreds of thousands of trades. So statistics don't apply sometimes. Like black swan events, unusual things. CEO comes in and gets caught that night with all the company's money and a couple dead girls in the back. And doesn't matter if your CEO is a guy or a girl, that's a problem for the company, right? All the company's money was in the back of the car and 2 dead girls. I mean, that's a problem. That's a black swan event. Planes flying into towers in New York City, black swan event. Hard to plan for, hard to account for. All right, so those are outlier events that don't really apply in statistics. Earnings announcements are difficult. They're binary events, and they can cause extreme volatility. Illiquid markets, penny stocks. I don't like to trade stuff under $20 with my patterns because those tend to be lower liquidity markets. There's also other markets like FDA approvals fall into black swan events. I like to avoid those. Leverage instruments tend to be more in the illiquidness. And then central bank interventions, rate changes, FOMC rate changes, those can change the game. Hard to account for in your statistics. The minimum and ideal sample size. Minimum 30, ideal 100. The real ideal 500. This proves clear, long duration results. Unshakable psychological confidence. If you find out the maximum drawdowns in there, that should be your minimum expectation. So pattern of 3, I like this roadmap bounce. That's what I've been talking to you so far. But there's also a measured bounce that I like to add in here. And when both of those patterns line up together, it becomes the rocket ship pattern right here. We don't need 50 indicators. I just need some high probability setups. So setup number one, the market roadmap bounce, already talked about. Price, you got to have an uptrend. You come back, you bounce off of that roadmap line. You get the entry on a price close above the 618. Target, the 1.1448. And next, you could target the previous swing high. That's a super conservative exit. The 1448 is a typical exit. And then you could go with aggressive target. You drop your win rate just a little bit, but 1272. I wouldn't go for the 1618. And then stop is always hard stop, dollar below the swing low of the reversal, period. I mean, you could also bump it up to just below 169 EMA. No mental stops allowed in this game. If any four of these conditions are missing, there's no trade. Now, why this works? I've tested it on the 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, monthly. These small moves intraday, driven by algorithms and day traders. Swing trading, driven by institutions and big money. And then the macro, long-term capital allocations, retirement accounts, people playing GDP and interest rates and stuff like that. We see this play out. So this works all time frames. Markets are fractal. The 1 minutes patterns build up to the 5 minute patterns, build up to the 15-minute patterns. These patterns just build up and build up and build up all the way through the charts. The math in these charts doesn't change. Now, the measured bounce pattern. The entry zone is the 618. So we're looking for, I was talking about a bounce before. This one, a little different. This one, you have a trend, you get a pullback. You're looking at the original low of the reversal and this high right here, and we're looking for a 618 retrace. Right here. This would be the potential entry. Right there. Profit targets. When you do this right here, you have to use a 3-point tool on the Fibonacci. You use this point as 0.1, this point as 0.2, this point is 0.3. That gives you an extension up here that's way above just the market roadmap pullback right here. And that 1272 is the target. It's a much bigger target. That's why measured bounces, much bigger profit right here than market roadmap bounces. So we find that clear reversal off a low, A, B. You draw the first 2 point from that low to that high, that A point to the B point, and get that 618 retrace level. Then when price comes down, tags it, that's your entry point for the bounce. You target a 3-point tool. And this is point C. You'd use a 3-point tool from A to B to C, 3 points, and get that 1272 up here. And that's your target on the bounce. You can play it right there. Works on all time frames. You can place a hard stop below the 786, which is below the 618 entry. If we dip on down below that 786 on that retrace right there, then price is probably continuing down. This pattern broke. Now, pattern 3 is when the market roadmap pattern and the measured bounce pattern, this just happens to be a 618 at the roadmap line. This becomes a rocket ship right here. And typically, you can hit the 1.618. This is usually where we caught a wave 3 in Elliott wave, tying it back to why Elliott wave. We caught a wave 3, the biggest, strongest, fastest move. We caught it right here with this roadmap bounce and the measured bounce coming together at one place, and we get an outsized move higher. It's the ultimate confluence, and it can be explosive gains if you catch that right there. Now, pattern recognition. How do you find these, right? I have systems in place that look for these. I used to spend hours of my day, every day, looking for these. Now, intuition is not some magical sixth sense market ability. It's just your brain subconsciously recognizing the patterns that you've seen thousands of times before. And in 2024, I looked at over 40,000 charts according to TradingView. You've got to look at thousands of charts. You got to be the one that does more work than anybody else if you want to be successful at this game. Got to have mechanical rules, massive repetition. It takes thousands of hours of screen time if you want to have a sixth sense at this trading thing. Trading intuition doesn't just come naturally. You've got to have it trained. Just like the plumber, you don't hire the new knee surgeon that just got out of medical school to replace your knee. You hire the guy that did tens of thousands of them last year, right? Same on your plumber. You don't hire the plumber that just got to be an apprentice to come fix your complex plumbing problem. You hire the guy that's been doing it for 50 years, 30 years, 40 years, because he's seen it all, seen some stuff, knows what, he just looks at it, he's like, I know what, I got a feeling I know what the problem is, right? Same thing with trading. Hang out with people that have tens of thousands of hours of trading time. Maybe you can learn a thing or two. And the golden rule, intuition can help keep you out of a bad trade that technically meets the rules, but something just doesn't look right. But it's never going to put you into a trade that breaks the rules. You don't want to do that. You don't be like, oh, the rules aren't in place, but I feel like this trade's going. That's the way to get losses right there. Patterns don't work if knowing what to avoid. If you're in chop zones, you're in binary events, FOMC events like today, you should probably avoid things like that. Low liquidity events, if the market's dried up, there's just not players, the volume's down, probably should avoid that. Parabolic FOMO, I stay away from these. Like oil going up, stay away from that stuff. Gold going up like crazy, we have FOMO, right? We as humans want to go get a piece of it. We don't want to be left out. That's a way to catch losses, though. And then thinking you know when a bottom's in place before it's in place without waiting for the reversal to show up, catching falling knives, you can lose a limb, you can bleed out, lose an account. Not knowing when to trade is probably the most profitable skill you can develop as a trader. Now, risk to rewards, these things determine survival in the markets. If you have a 1-to-1 ratio, you need at least a 50% win rate. If you're going to risk 1 to gain 1, 50% win rate. If you're going to gain 2 for every time you lose 1, you need a 33% win rate to be profitable. If you can gain 3 for every time you lose 1, you only need a 25% win rate to be profitable. If you gain 5 every time you lose 1, you need a 16% win rate to be profitable in the market, or to be break even right there. Need above 16. You need above these numbers to be profitable right there. Now, stop loss is not optional. You need mechanical rules. I stop out dollar below the low, and you got to have brutal adherence to this. Middle stops, they're just excuses to hold losing trades, hoping they recover. One trade without a stop can erase 20 winners worth of profits very easily. The stop loss is your business insurance to stay in this game. You got to put a hard order in, or an alert that you take action on. The market can remain irrational way longer than you can remain solvent. It's a famous quote in this game. Now, position sizing that matters, 1 to 2% per trade. That's what you need to do. All right. Think about it this way. You risk 1% a trade, take 69 trades to lose 50% of your account. 69 losses in a row. If you risk 2% of your account per trade, 35%, 35 losses eat 50% of your account. 5%, you're down to 14 trades, eats 50% of your trade, 50% of your account. If you risk 10% per trade, 7 losses take 50% of your account. Now, 10 losses in a row is relatively common across a lot of systems. So if you're in here risking 10% of your account on a trade, 7 losses can eat 50% of your trading capital right there. And that's in the expectancy, 10 losing trades. Looking at tens of thousands of trading systems, 10 trade losses, streaks, they can ruin your account if you're risking big money. Now, I trade a beer money trade. If you've ever heard me talking about this on YouTube or some other show, I go for a 3 standard deviation win rate. And I'm very careful about this because, a lot of people equate it to picking up pennies in front of a steamroller. This is a very outlier event. 1 in 333 days, I would get hit. and that would touch my short strike. So this, you see people selling far out of the money options, 3 standard deviations. You've got a 99.7% mathematical probability that this works out. And I usually do it for a very short duration. I buy very little time risk. And because the probability of winning is so high, the market pays you very little for taking this trade. It's a very small premium. I call it beer money. And you technically expose yourself. I technically expose myself to massive risk with this trade. Yesterday I took on $140,000 of risk to make $1,700. I made that in less than 3 hours exposure to the market. But there's a black swan event that could come get me. And that's a reality of this trade. I could lose that 140. Now, long tail risk, when time works against you, the extreme probability events, those outsized black swan type things, they can wipe you out on a trade like that. So you don't get paid to hold through the most dangerous part of the trade, which is the final bit of expiration. Now, if you're going to play longer term trades, 21 days to expiration is a great place to roll. But a lot of us like to play shorter duration than that. But the statistics say that playing further out than that is actually safer. Just so you know. Drawdown, the metric that matters, tells you if you can survive at a 40% win rate. Probability of 5 losses in a row, 99%. Probability of 10 losses in a row, 15%. But you could get it. 50% win rate, probability of 5 losses in a row, 97%. Think about this, 5 losses. Can you survive 5 losses? If you're trading something with a 50% win rate, 97% chance you're going to get 5 losses in a row. 60% win rate, 80% probability of 5 losses in a row. If you jump up to 70%, this is why I like to push the win rate above 70%, because now you're down to a 45% chance you're going to get 5 losses in a row. And this creates more certainty for the trade. Probability of 10 losses in a row drops down to 0% at above 70% win rate. It's just a long tail risk. That's why, like the 97%, the 3 standard deviation, winning 99.7% of the time, your chance of, your expected loss is incredibly low. But that one big loss will probably come get you. So win rate, it's the percentage of trades that result in a profit. And the flaw is going after a super high win rate can psychologically get you right there. Profit factor, that's gross profits divided by gross losses. That's a better metric to measure a system by. But expectancy is the real magic right here. It's the ultimate mathematical thing that tells you if you have a profitable trade, and it's something you should bet on. So expectancy is the win rate percentage times the win rate average win minus the loss rate percentage times the average loss. This gives you the expectancy of a trade. And this is probably the key formula that you should use on a trade. Now, profit factor in practice, if you're less than 1, you're bleeding. Losing money. No mathematical edge. Profit factor 1 to 1.5, marginal system, but it can work. You gotta perform though. The solid system, 1.5 to 2, and this is where you can take a system in this range on shares, add options, and bring it into this range and become a solid system. Or even this range where it's an exceptional system. High profit factor provides a necessary buffer against slippage, commissions, and inevitable human errors of placing the wrong trades. Putting it all together, you want a sample size over 30, you want a risk reward over 1.1 to 2 if you can, position size around 1 to 2%, keeps you in the game on drawdowns, profit factor above 1.5 if you can, expectancy, you want that to be a positive number on the long term. That's what makes up a high probability trade right there. So the 7 truths in statistical trading, 30 trades, absolute minimum for a statistical significant edge. High probability trades are confluence across multiple time frames. Stop losses aren't optional. They're business insurance. You got to have good position sizing, like 1 to 2% of your risk. And it's the only variable you have 100% control of in the markets. Win rate is an ego metric. Expectancy is the master metric that proves you have an edge. Win rates are, people brag on that all the time. It's an ego metric. Intuition in the market is not magic. It's subconscious pattern recognition built by massive repetition. You got to trade a system mechanically without emotion to let probabilities play out. Trust the math, execute on the system, survive drawdowns. And this is the math of the foundation, system execution. Now, up next, I have a system I want to show you. It's the Apollo Smart Algorithm System that takes all these principles and applies it with mechanical entries and exits. And I've upgraded the system to give you options to boost those win rates, get those higher profit factors in there, give you a long-term survival. David, I think you're going to play that replay for us
I
right
do,
here.
but I got a couple questions if you got a couple minutes.
Yeah.
Yeah, first of all, great presentation. I mean, tons and tons of information. I think people are going to be going back and watching this 3 or 4 times. One question was if you have a source for good Elliott wave research.
There is the book. Let me pull it up here on Amazon. It's Elliott Wave Principle of Practice by Frost and Pretcher. And let me pull that link up. I can throw it in the chat here when I get it pulled up.
Tess, this replay will be available on the opening playbook replay page, and then I was going to ask Jeffrey if he would mind sharing the slide deck. We can put it in our slide deck document also.
Yeah, I'll try to do that here for you. Just a second. Let me grab this book right here. Copy. This is what it looks like right here. Frost and Pretcher. And I'll have to move that back over because I put that on top of the chat right there.
Cool.
So here's the book right there on Amazon. You can get it anywhere you want. You can get a digital copy. I actually take physical notes in the book. That's considered the Bible for Elliott Wave. So
Good
if
deal.
you want to learn it, that's the place right there.
Good deal. I think I'm trying to remember who was asking about that, but I don't remember. Oh, Chris. That was for Chris. And then Keith was asking what your criteria for reversal is, like a certain number of candles just touching or closing. Like when do you
So
consider it a reversal?
there's reversal you can do it with candles. You can do it you do it lots of ways. Price action is one of those things you learn. And I'll just pull up a chart real quick and show you like what a potential reversal looks like right here on AVGO. Just the chart I have up. This is a market roadmap bounce right here. There's the roadmap line. That's the 144 and 169 EMAs. Golden road brick, golden brick road. And prices come up. That's a trend. Made an extreme. Came back down. Tested the roadmap line. And we've just been sitting here. I am waiting for close above that 618 to indicate that we're going up here. I mean, you can see it drawn. Like I didn't even plan this. This is just drawn on the chart. Like I do this all day, every day, right there. This potential reversal in place. I'm waiting for the confirmation on the close above the 618 to get the high probability trade right there on
Yeah, but I
AVGO.
think you answered the question with you're waiting for it on the close, not just touching it during the day.
Always watch for closes, never trade inner candle. But this works on the 1 minute time frame also. If we look at something like SPY.
Manisha asked what kind of instrument you normally trade. Do you trade SPX?
I trade a little bit of everything.
Trades everything.
There's not a limit. You see this pattern played out right there. There's the high, here's the low, here's the entry, there's the target.
Well, one of the things on one of your last slides there was, not had to do with intuition and it not just being some random emotion, it being based on, kind of like a subconscious recognition of a pattern. One way to avoid doing it emotionally and on a whim is by automating it, which you've done with your Apollo Smart algorithm. If you have it automated, you can't put emotion in it. It's just going to happen when there's a real pattern. And we're going to play that presentation for everybody now to see how you took this to the next level.
Yeah,
But thanks
absolutely.
so much for doing this class. A lot of people appreciate it in the chat there.
I did throw the slideshow in the chat. Should have viewer only permission. If you want to ask to edit or something like that, just make your own copy and you can make notes or whatever you need to do.
Perfect.
On the slideshow.
Awesome. Thanks so much, Jeffrey.
Yeah, and thanks for having me on here today, everybody. Hope you learned something interesting, and we got that presentation for you now.
Yeah.
on, get this, 2,434 trade signals with an average hold time of 3 days on the underlying stock. And what you'll see today is an internal audit that took these real issued trade alerts and applied a set of options criteria to them, meaning each option gain is hypothetical and uses the benefit of hindsight. We cannot guarantee any specific future results, as there's always a high degree of risk involved in trading. So see our terms on the homepage for more information. Now let's be real. In trading, there will be losses. There's no black box miracle system that prints out winning trades automatically. And the whole purpose of Jeffrey's research and work with traders is to help give you an edge in the markets. And if you can't handle a losing trade, then you really shouldn't be trading with real money. Again, losses in trading have occurred and will occur in the future. Hi, everybody. I'm Jack Carter. Thank you for being here. While everybody else